Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement, and I am excited. We are back, joined by one of our favorite guys. He is Chicagoland's CFP certified financial planner, Tim Stearns, here with us on Protect and Grow. Welcome back in, Tim.
Peter, thanks for having me.
Always a pleasure. We appreciate the time and the guidance and the perspective, Tim, that you provide savers and investors across Chicagoland. It's a crazy financial world, Tim. I guess it would help if we all understood the options that we have, the choices of where to put and place and invest our money a little bit better.
Yeah, I mean, unfortunately, in this low interest rate environment, I'll start out with banks. I mean, checking accounts, savings accounts, even CDs, money markets aren't paying worth a darn. And so people are a little frustrated as to where to put their money. They want safety, but they also need growth. And, with the Fed pegging inflation rate at 2.5%, you're earning, 0.1% on my money in a CD or what have you, I'm actually losing money. So we try to educate people as to, there's other alternatives out there. One of the ones I really like, and I did it for my mom, is the multi-year guaranteed annuity, which is paying 2.5%. It's a 3-year hold, but I mean, if you're looking at 3-year CDs, this is a much better alternative.
Sure, yeah, Tim. Anywhere we can improve that interest rate is long-term going to help us out financially, right?
100%.
Have you seen, because of the market volatility, Tim, that a lot of people have left their money in cash and now maybe significantly underperforming as a result?
Yeah, definitely. We have a lot of people who come in here, and we try to obviously educate them as to the fact that just because your money's in the bank doesn't mean you're making money. You're actually losing. So we make sure that people understand the concept of inflation erodes the dollar. Basically, what we tell people when we're doing income allocation plans is that we need to make that dollar double every 22 years.
But Tim, there is a time and a place for having money in the bank, and there are different types of accounts in the bank that serve different purposes, right?
Right. And we tell people, they ask, how much should I have in a reserve? A lot of times we see people with way too much in reserves. We tell them, if a husband and wife are working, the rule of thumb is to have 3 years, 3 months in reserves of their bills. And then, if one of them is not working, to have 6 months, as a holdback, just in case for that rainy day or something happens.
That emergency account.
Exactly. After that, I mean, they need to go looking for some other areas to put the money in to make money back.
I heard a great definition of an emergency account one time is that if you don't have one, it's an emergency. If you do have one, it's an inconvenience.
That's so true.
Yeah.
So
if
true.
You can stroke a check for something and the problem goes away, it's more of an inconvenience than a true emergency. If you have to go into debt to replace a popped tire or to buy a new fridge or what have you, then it's truly an emergency.
Right. I agree. We always tell people that you should have some, but not too much. We've had people come in here with hundreds of thousands of dollars sitting on the sidelines doing absolutely nothing.
Yeah, and Tim, in this interest rate environment, earning less than 0.5% in many cases, that interest rate that you quoted, about 2.4% for 3 years, that could be an increase of 3 to 6 times what a lot of people are making.
Right. One of the things we love to do for people is we can run a report called Lazy Money, and that report will show them, a breakdown of what they're missing out on, and that their money is just kind of being lazy.
Well, again, Tim, I know that a lot of people have been a little bit more concerned about the volatility of the market and may have left money in cash or even moved money to cash during the midst of the coronavirus pandemic, COVID-19, or even long before that. Some people have had that cash sitting in those accounts, Tim, for quite some time,
Yeah.
decades or more in some cases. Again, we need to have a plan to get that money growing. If you've got any lazy money or money that you're not excited about the performance on, give Tim Stearns a call. He can help you understand the proper placement of your money and understand your investment options. That's what today's program is all about. Give him a call, 800-640-2256. That's 800-640-2256. And Tim, sort of as we go here, we may move up the scale of taking some amount of risk. The more conservative side of the investment portfolio has always been the bonds and bond funds and fixed income, correct?
Exactly. So when I started out in the industry in 1994, your flight to safety for, being in the market was to get out of the market and go into bonds. Unfortunately, in 2008, both bonds and stocks went down, and we saw back in March, bonds went down again. So, it's not as safe as people think. There is a lot of different types of risks, and I'd like to, we can go through each one if that's all right.
Yeah, sure. Let's talk a little bit about the risk that's associated with what has traditionally been promoted as the safer side of our portfolio.
Right. So there's many different risks. You have default or credit risk. The risk that the entity that you have the bond with will not be able to pay back the loan. We have interest rate risk, which a lot of people don't understand. But think about this: if rates go up, the value of the bond you hold, it might go down, and if you need to sell it before maturity. So what we try to explain to people is, think about this: if interest rates are going up, and I have a bond at, let's say, a coupon of 4%, and they're issuing new bonds at 4.25, my bond doesn't look so great to the new bonds that are coming out. So I have to sell it at what? A loss. So a lot of people don't realize that can happen in a bond. The other thing is duration risk. Bonds are generally longer term investments. What happens during the time that you hold a bond over a longer time can potentially be a risk, just because you're holding on to it, and maybe there's better opportunities out there. The other one is call risk. If interest rates drop and the entity can borrow at a lower rate, they're going to call the bond. Why would you pay more than you have to? And then, of course, you have bond rating risk. A lot of times we're seeing people that come in here when we're analyzing their portfolio, their bond ratings are terrible because they're just trying to get a return. So they're in junk and they don't even realize it.
Well, again, these are what has traditionally been the safer side of our portfolio. And Tim, that laundry list of risk that you just talked about would indicate that maybe they are not the golden standard of safety that some purport them to be, and that they are used as when balancing out our portfolio. So we really need to be cautious and careful, proceed with caution here when we are talking about the bonds, the bond funds as a conservative option to stocks and equities, right?
Right. And I think people saw that in 2008, which was pretty darn scary. And I think that sometimes they're getting forgetful that, they've had the market go on a holy terror, right? And then they only have so much in bonds. And when you go and look at the bonds, like I said, a lot of times they're junk because they're just trying to get a return.
Yeah. Well, again, if you need help, ladies and gentlemen, if you would like to look at how to identify underperforming assets, if you would like to look how to lower fees, lower the risk, increase the returns on your portfolio, a lot of times that can be done through an analysis. And a lot of times that can be done through identifying the underperforming bonds or bond funds inside of that investment portfolio. Tim Stearns is a certified financial planner. He can help you make sure that you've got that proper mix of investments, that you understand all of your investment options. It's a big part of your total financial picture and financial progress. And again, if you need that help and assistance, if you need that protect and grow plan in your hands, pick up the phone and give Tim Stearns a call, 800-640-2256. That's 800-640-2256, 800-640-2256. And Tim, you often mention and make an offer for a book on this program, the income allocation book. This week, a little different book, the Understanding Your Investment Options book.
Yes. It's a great book written by a very good author named Pete Rashan. So I'm going to give you your props.
Appreciate it.
No, but it's a it's a really good book because it boils down how different things work. A lot of people have a cursory idea of certain vehicles, your book kind of, waters it down so that it's real straightforward. You can understand, what is what, and it's very informative. I think it's a easy read. And again, it's well written.
Yeah, thank you. Thank you very much. Yeah, not meant to be a page turner, probably the cure for insomnia, if we're going to be brutally honest about it, but it was meant to be able to turn to a particular section, read a couple pages, and then have the basis for an informed conversation, whatever the investment option that you wanted to discuss would be. So whether it's bonds, stocks, mutual funds, ETFs, cryptocurrency, gold, insurance, all of them are discussed in the book. Short, easy to read chapters, just a few pages on each one, and you can digest and then have a good informed conversation and basically understand the risks that you are taking and where the proper utilization of whatever tool you're considering might be. If you'd like a copy of that book, get in touch. Tim Stearns making those available on today's program, 800-640-2256. That's 800-640-2256. So Tim, we continue up the scale of taking a little bit more risk or being more aggressive. After the fixed income or conservative side comes the equities, and there most people think of stocks.
Right. And stocks are a great thing to have. I mean, people, I'm all for it, but you have to be careful as to what you have. We have people come in here, and when we do the risk analysis, it's shocking how much risk they have that they don't realize. We when we run risk alerts for them, they say, "Oh, I've already taken." My other advisor had me take a questionnaire as to what my risk was. Well, this thing, you can't cheat it. You'll know exactly how much risk you have inherently in your portfolio. So I would tell people, give us a call, and we could take a look at what kind of stocks you have. One thing I'll be proud of is that, like in March, we went to cash. We got out because, share prices can rise and fall, as we saw. The market was down 22.3%, and, we were down a couple percent. So I will brag about that because that's huge. Another thing I like about some of the stocks is that they're paying dividends. That's nice. You can take dividends as income or reinvest to buy more shares, which is always nice. There's many types of companies and there's many types of stocks. It's a good opportunity for growth above inflation. So, but of course it comes with risk, higher risk of loss at a company's higher potential rewards.
Absolutely. Well, Tim, we are looking at stocks. We are, in fact, an owner of the company, and we really hope for growth or income in one of two ways. One is the actual value of the company, the share price, and the other is in the profits that the company generates, which is kicked out to owners in the form of dividends.
Right.
These can be a great component of a growth-oriented portfolio, but like you said, there's risk there. So maybe it's not the place to bank everything and think that is going to provide us for a stable retirement income plan.
Right. I definitely would not do that. A lot of times we have people come in here who are doing, asset allocation, and basically they're reversed, so let me give you an example. We had a 60-year-old come in here. He had 60% of his portfolio in stocks and he had 40% in bonds, when in fact that should be reversed. Especially this gentleman was getting ready to retire, and so he's taking a lot of undue risk and not really realizing what he has. One of the other things we do is we try to use stop losses, which literally means you put a price in so that you don't lose if the market drops precipitously like it did in February.
Yeah. Well, we know that while 2020 was a crazy year, Tim, there's more surprises in store for us into the
Right.
future. It's not like we ever have a routine year in the stock market. It's unpredictable each and every year. But again, if you want to understand your options and where and when they are appropriate for achieving specific financial goals, ladies and gentlemen, you need the help. You need the assistance of a certified financial planner. Give Tim Stearns a call, 800-640-2256. If you'd like a plan put together, it will outline where you're at, give you a snapshot, define your goals, have them written down, and then talk about specific recommendations, executable action items on how you can allocate and position your dollars into these different investment options to have your dollars work more effectively to achieve your goals. Again, if you'd like that Protect and Grow plan, if you'd like the book, Understanding Your Investment Options, pick up the phone, give Tim Stearns a call, 800-640-2256. That's 800-640-2256. Now, Tim, do we need to understand a distinction between a stock or stocks and then the stock market indexes that we see on TV?
Well, I mean, a stock market index is just a compilation of, like the S&P 500. It's the 500 strongest companies in the United States. The Dow Jones is a little bit broader. It covers a lot of the stocks, and then of course you have like the Nasdaq. One of the ones that we like using is the Nasdaq 100. We're very happy with that. Obviously, that's performed great this past 3 months or so. There's been growth there quite a bit. Fortunately, all good things do come to an end, so you have to be careful. Just because you're in an index doesn't mean you're diversified completely, where you shouldn't be keeping an eye on things.
Well, again, what we see in the news might not represent what's in our portfolio. And that's, I think,
Totally.
the important distinction, right, Tim?
100%. You have to be careful what you exactly own. There's certain stocks that everyone, do you own this stock or that stock? And some of them, they don't even have earnings.
I probably do in one of my
Yeah.
mutual funds, right?
Right. Yeah.
And then that's on our next item on the list, Tim. Mutual funds are a great way to diversify, but sometimes people don't even know what they truly own inside of them.
Right. It's a very common form of investment. Most 401ks, that's where you're going to put your money. I'd say 99% of them out there. Unfortunately, just because they're diversified doesn't mean that they're not going to fall down. The other thing that's interesting, and we talk about this in the other book that we give out, Income Allocation, it's noted in there that 80% of money has to stay in the stock market. So if you're a money manager and the pandemic happens like it did in February and March, where the market went down by 22.3%, those guys cannot go more than 20 cents on a dollar to the sidelines. So unless you make an inbound call to the mutual fund company and tell them to go to cash, they won't do it. So they can't. It's against the law. It's the Investment Company Act of 1940. A lot of people don't know that, but that's huge to know that.
It basically says that, Tim, on a nice, sunny, dry day around Chicagoland, we might feel comfortable driving the posted speed limit if traffic allows. However, the mutual fund continues to drive the posted speed limit regardless of road conditions. So even if there's a quarter-inch sheet of ice coming in or a traffic jam ahead, it's going to continue going at that posted speed limit regardless of conditions. That's an analogy for you, but the equivalent of what mutual funds are required to do.
Right. And that's, a lot of people think, well, I'm in a mutual fund, I'll be fine. We show them, in 2008, you lost 36%, in March, you lost 22.3%. These are, they're not a cure all. They're not a silver bullet. A lot of people think, oh, well, I'm in the target date, 2020. 2021. Whatever.
Also not adjusting for conditions, only adjusting on a preconceived algorithm formula, right. Not truly the gold standard of safety or the cure-all for asset allocation that they are sort of used to promote and be. So again, there's a time and a place for them. They are a useful tool, but they are only a tool and one of many that you have the options to pick and choose from. You've got to understand when and where they are appropriate. And Tim, they're sort of modern evolutions of mutual funds that are far more efficient and for the most part, less costly.
Exactly. And one of the things we always say to people in our retirement classes is, in 2008, did you have any outbound phone calls from your mutual fund company advising you to go to cash? And I've never had anyone raise their hand, because they don't get paid unless the money is in the market. So, again, it's not a cure all. You need to know what you have. A lot of times we show people their turnover rate, which is simply the cost of trading. And, even these no load funds, their turnover rate, sometimes is 300%. Well, that's 3% you're paying a year to have your money there, and so know what you have, and look under the hood.
Well, next on a list here, we want to understand all of our investment options. If you've got a question, if you would like to get a better handle on these, pick up the phone, give a call. Tim Stearns, making copies of the book, Understanding Your Investment Options. Very good book. He's making those available to you today. Pick up the phone to request your copy, 800-640-2256. That's 800-640-2256. Tim, it also explains annuities, and there are many different types of annuities. You utilize annuities in some circumstances. Now, not for everybody's circumstance, not a cure-all either. However, they are also a tool that has a specific time and a place and a usage where it can be appropriate, correct?
Exactly. I mean, we have a lot of people come in and say, "Oh, I don't like annuities. I don't. What don't you like them? Well, they're bad. What don't you like? They're terrible." I mean, there's no specifics. I think annuities got a bad rap about 20 something years ago. They've evolved, and they're a great place instead of using a bond to get your fixed income portion of your portfolio going. And it's guaranteed. It's not at risk in the market. It mirrors the market, and you're going to give up some of the uh, growth, of the actual stock market, but yet, the worst you're going to get is a zero from your annuity, which I think is outstanding. And the fees are low. There's different annuities out there. You have, variable annuities, which I'm not a big fan of. I've never sold one or let a client purchase it through me because I don't like the fees that are in there. They're embedded in there. One of the things I'll offer to anybody is if you have a variable annuity, let's call the three of us. We'll call, we can call the variable annuity company and really uncover the fees, mortality expense, the mutual fund underlying it. There's all kinds of fees that are just buried in there. And that's just not a very good place to be, I think.
Well, again, if you need a better understanding of your current annuities, if you're looking for some source of guaranteed safety of principal protection for what you've built up and you are looking to generate income from it in the future, may be an appropriate consideration for you. There are times and places where each one of these tools can provide you measurable benefits. They are all designed to help you achieve very specific goals. And that's why there are so many different investment options and why you've got to understand where each one can be utilized. Pick up the phone, give a call, talk with a certified financial planner, get that protect and grow plan in your hands, which will help you identify where and when each of these is appropriate to help you achieve your goals. 800-640-2256. That's 800-640-2256. Tim, I spoke of sort of a newer evolution of mutual funds earlier, and that's really what EFTs, exchange traded funds, ETFs are. They're a little bit of a newer iteration of mutual funds, more efficient, aren't they?
They really are, and their fees are low compared to a mutual fund. I love that you can get into a specific index if you want. You can, oil, gold, you name it. Uh, Everything is out there for you, and it's been a really great way uh, to invest for the average Joe to put their money in there. We, with our clients, we actually build them an ETF based on what their risk analysis is and that type of thing. So I'm very familiar with how to do these. I really enjoy seeing, they're tax efficient. They're better than non-qualified mutual funds.
Well, again, if you have questions, concerns, if you feel like you could be more efficient, you're paying too much in fees, you're not getting the returns that you desire, pick up the phone, give Tim Stearns a call. He's here to help and assist Chicagoland area savers and investors. Make sure that you are on track and that you've got a plan in place. 800-640-2256. That's 800-640-2256. Tim, probably limited on time here, so just a couple others real quick. Real estate, life insurance, those are two more different options that are discussed in the book. But at the end of the day, we also have to consider how we classify each one of these investments. And right now, a lot of people are worried about their taxes and the tax status of their retirement accounts.
Right. So a great way to put some money away. We like to call it a Roth on steroids, is a fixed index universal life policy. And what it does is it literally allows you to put away after tax money that will grow tax deferred and tax free when you pull it out, because it's a loan against the policy. It also will have most of these have now a hybrid where they have some long-term care components in it, which is outstanding.
Well, again, all of these, Tim, have certain times and places where they are appropriate. But right now, a lot of people looking at concern for the future of what taxes may bring and looking for any way to possibly control their taxes into the future. I know that during the course of your investment lifespan, you got to be doing proactive tax planning. But right now, it's pretty vitally important.
Exactly. And I think that the tax laws are going to change yet again. And that's the nice thing, that we have a CPA on staff here so that we're staying up on all these different changes that are coming.
Well, again, ladies and gentlemen, if you would like to speak with a certified financial planner about your questions or concerns, if you would like to get a Protect and Grow plan put together, if you'd like a copy of the book, Understanding Your Investment Options, or of the book, Income Allocation, pick up the phone, give Tim Stearns a call. He makes those available to listeners to the program. The book's available if you've got more than $500,000 saved for yourself for retirement. Income Allocation would be appropriate. I think Understanding Your Investment Options may be appropriate for anyone, but for the first 10 callers, Tim Stearns will make those available to you. Pick up the phone and give a call, 800-640-2256. That's 800-640-2256. And the Protect and Grow plan, I think that alone worth the time that you would have to dedicate, that you would invest into getting that put together. Show you measurable benefits in achieving your goals because you have them written down. You've got an easy to understand document that you can refer to on how to achieve those goals. Tim Stearns will put that together with you and for you. No cost, no obligation, no downside for placing this call. 800-640-2256. That's 800-640-2256. Tim, we always appreciate the time. Thank you for being here on Protect and Grow Chicagoland Retirement.
Thanks for having me, Peter.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.